Hi everyone. Today I'm going to be talking about one penny stock that I think can easily triple. It's really beaten down, but I think there's an amazing catalyst, and I'll get into that. So essentially, what the penny stock is it's Chegg. Now, if you guys haven't heard of Chegg, it's simply kind of a homework help service where students will pay a subscription to help find solutions to whatever question they may need help on. Now, if we take a look at Chegg, we're going to see that it's $1.77. And since the start of the year, it's down from 11.47, which is about 85%. And since its COVID all-time high, it's down from 115, which is about 98%. So essentially, right now, the reason it's down so much is that the market believes that AI is essentially killing these homework help services. I do think that there is some sort of truth to that, but I don't think it's completely true, and I'll explain a little bit more in a second. So essentially, on July 26, 2024, Homeworkify was shut down. This is the main catalyst of why I believe Chegg can have a huge run, because essentially people have long stated that Chegg's downfall was ChatGPT, other AI stuff, but it's really tough to believe since AI is almost useless, to be honest, for homework, and ChatGPT can hardly even do math. ChatGPT is okay at coding to a very low level, and it's okay at writing to maybe a modest level, but anything else it simply can't do. And if ChatGPT was as good as people said it was, there wouldn't really be university students. The idea that ChatGPT or other AI things are killing Chegg is the same kind of idea that PhotoMath or Wolfram Alpha would kill Chegg. And those are simply much more accurate services that have been around for much longer. With things like ChatGPT, if you ask it a question, it'll always essentially give you an answer. It won't say, I don't know. And that's terrible because a lot of times you give it a question and it'll just give you a wrong answer. And there's no rating system or anything. So when you get a wrong answer, if you also don't really know, you can't do anything about that. Whereas with Chegg, if you get a wrong answer, there's some sort of upvote, downvote system, so you'll be able to know. Now, the reason I mention Homeworkify being shut down as such a brilliant catalyst for Chegg is because Homeworkify was the real thing that was killing Chegg. What Homeworkify is it's essentially a malware that allows you to see Chegg's answers without actually having Chegg. Why would you buy Chegg if you could essentially use Chegg for free? You wouldn't, and that's why Homeworkify was killing Chegg. Now, with Homeworkify being shut down on July 26th of this year, which is this quarter, I believe that Wall Street is unaware of these amazing effects, and I believe Wall Street is essentially slow and they're lagging behind, and once the earnings report comes, they'll realize, and that'll boost Chegg's price. If you look at the chart, you see Chegg is just hovering pretty close to its all-time lows, so it's quite obvious Wall Street hasn't really picked that up. Now, if you look at the quarter three guidance, you'll notice it's extremely low. So Chegg doesn't really need a stellar quarter to jump. All it really needs is to have an inline quarter or perhaps just an uptick off its downtrend. And the shutdown of Homeworkify can easily give that because a lot of people who are using Chegg indirectly with Homeworkify are now forced to buy Chegg to actually see Chegg's answers. Now, one other positive catalyst I'd like to mention is that AI might actually be beneficial. And I just want to point out Reddit as an example because Reddit is selling user data for quite a hefty sum, and Chegg is not doing that, but they have quite a lot of useful content that they may be able to use in the future if management could get something going. Now, with AI being a risk to Chegg, in some ways it improves Chegg. And with that being said, an example would be Chegg was able to create cheaper content while having more questions. And for users, that's good. If you're a more satisfied user, you might be less likely to cancel. Although in the long run, I do believe AI will hurt Chegg. In the interim, it could benefit Chegg periodically. Now, I think the biggest risk with buying Chegg really is their dilution. Now, if you look, they've purchased a lot of shares off the market at very high prices, and now with much lower prices, they're in a little bit of a tricky situation with only 4.5 million in net cash. Essentially, Chegg is one of those companies that relies heavily on stock-based compensation. If you look at their trailing 12-month stock-based compensation, you'll see that they gave around 111 million, which, if you compare that to their market cap at the current price of $1.77, you'll notice that their stock-based compensation is about 60% of their market cap if we look at trailing 12 months. Now, this is quite because they have dropped so much. Like, if you compare the percentage based on where it started in 2021 at 1147, it'd be a much smaller percent. And just with the current price and market cap, their stock-based compensation will cause an extreme amount of dilution, and their lack of net cash essentially, and a lot of current liabilities more than their current assets, will not allow them to control this dilution. So I believe dilution is truly the biggest risk to Chegg right now. Now, one thing I want to add is Chegg's management is horrible. And that's kind of what makes investing in turnaround plays so tough, is because oftentimes their management is very, very poor. What Chegg's management did was they bought back a ton of stock at high prices, and now with these horrible low prices and not the best balance sheet, and all this stock-based compensation, essentially what they're doing is they've just bought high and they're selling low. And this is really effectively worse than what the airline companies did. And we all know they have horrible management. So one thing to note is Chegg has a new CEO, which came in about 3 months ago. And while that might be able to change things a little bit, I don't really think it'll help that much, because he was an executive that was at Chegg for quite some time, and he was promoted internally, so he's probably just as bad as the old CEO, but maybe he's useful. So I want to talk about Chegg's numbers just a little bit here. And essentially, if we look at their free cash flow, it's about 90 million over the trailing 12 months. So they're trading at a price to free cash flow of about 2, which is pretty low, but keep in mind this doesn't consider stock-based compensation. And if you consider their stock-based compensation, they're a little bit net negative in terms of net income. And just last quarter, they had a huge negative net income due to an impairment on their goodwill. But ignoring that, because it's not very relevant, the company is essentially a non-profitable company trading at a very low price to free cash flow since it's dying, and it's powered by heavy stock-based compensation. So it trades at a low price to sales ratio as well. One thing that's a little bit nice is it trades at just over its book value if we're excluding its goodwill. And with that being said, I don't think there's too much imminent downside. And the only real downside is probably over time through some sort of bleed with their dilution. So despite all the negative things I've said about Chegg, I am incredibly bullish because I do think it has one of those catalysts that can turn things around. And with a good catalyst that makes Chegg look like a company that's either growing or at least stabilizing, I think it's multiple can easily expand from 2 times its free cash flow to 6 times its free cash flow. So with that said, in terms of a position, I think Chegg being a penny stock in a secular downtrend with major risk, I think the reasonable position sizing is at most a 1/10 of the Kelly criterion. And for my calculation, I use the parameters that's a 50% chance of winning, 50% chance of losing, with a potential loss of 37.5%, essentially accounting for if they dilute by 60% over the next year, and a potential gain of 200%, which is their cash flow multiple expanding to 6 times. Using those parameters, you get a Kelly criterion number of about 40.6%. So I believe with the 1/10 of the Kelly criterion being it's a penny stock in a secular downtrend, I think the maximum reasonable position sizing should be 4%. So yeah, that is about it. And just one last thing. If you guys are wondering if I have a position, I've just done my research. And to be honest, I'm still on the fence. So as of now, I don't have a position and I'm still considering it. But I hope this video helps and you're able to take the major catalyst into consideration. Thank you guys for sticking in this video. Please share with someone that you think should also buy Chegg.